So LEAPS is basically just an acronym, and it stands for Long-Term Equity Anticipation Securities. And if you were to take a look at the option chain in your brokerage software, you will see that there's actually no label on the option chain whether it's LEAPS or not. So basically it's just characterized as having a DTE, which is days to expiration, of more than 1 year. Now, same thing, LEAPS, there are puts and calls. So call LEAPS are generally meant as stock replacement strategy, and it's better to use on non-dividend stocks because you do not get dividends with options. So if you were to just buy the stock, and if the stock was to pay you a dividend, then on the ex-dividend date, the stock will theoretically go down by the same amount that the dividend is being paid out. So you actually do not lose anything when you are owning the stock. But if you own a call LEAPS, you actually do not get paid the dividends. So the value of your options is actually tied to the stock. So if the stock goes down, your option value will drop as well, but you are not being paid the dividend. So it's best for you, I would say that it's much better to use on a non-dividend stocks, or at least on a stock that pays very little dividends. There's also put LEAPS as well, and it's generally meant for long-term portfolio protection to the downside. So this is where many people would tend to use buy put LEAPS on index ETFs as a general protection in case the market goes down. So for the purpose of this video, I'll just only be talking about the call LEAPS options. So you must be wondering, why buy LEAPS versus stocks? So here are some of the advantages. So first of all, you get to control a stock at half price or less. Now, when I say control, it means you just get exposure to the underlying stock price movement. You actually do not own the stock. So I want you to take a look at this strike price at 60 right here. You can see that the bid is about 53, the offer is about 54, so you can roughly buy this option price at $54, and just by itself you can see it's already half the price of the current stock price. So the current stock price is about 108. If you were to buy 100 shares, that is about $10,800. So by paying only $5,400, you can get the same exposure of about 88 deltas with very limited risk compared to if you were to buy 100 shares of this stock. Now, of course, you can choose to pay even lesser if you will go to the 105 strike price. As you can see, with the 105 strike, you can buy this option at about $23, which is about $2,300. So you even further your limit to the downside. But I want to caution you here, because if you were to buy this at the money option, you're actually paying more in extrinsic value. You see, if you were to compare this is the extrinsic value column. You can see that with the 105 strike price, you're paying roughly $19 in terms of extrinsic value, whereas the 60 strike, you're only paying roughly about $5. So there's a big difference, and you must keep in mind that when the option expires, all extrinsic value will go to zero. So what you're actually buying here is more extrinsic value. Although you are reducing your risk, most of this value is actually extrinsic value, and that means that the stock really has to go up a lot in order for you to break even and even profit, compared to if you were to buy much deeper in the money with a higher delta option. Alright, but I'll get more into this in the later slides. So with LEAPS, you can actually reduce your risk by half just by simply deciding how much you want to pay for the option. So if you compare this to stock, with stock, let's say if you buy 100 shares of a stock that is worth $100 and it goes to zero, well, you lose the full $100 times 100 shares, that's $10,000. But if you bought the LEAPS options for $50, it goes to zero, then you only lose whatever you paid for, which is a total of $5,000. So just by that, you are really reducing your risk while still being able to get exposure to the upside. And the other good thing about LEAPS is that you actually make more as the stock goes up and you lose less as the stock goes down, and that's because the delta is dynamic. That means as the stock moves, the delta moves as well. So delta is just a measurement of how much the option price will go up or down per dollar move in the underlying stock. So let's say, for example, if you start off with a delta of 80, And if the stock price was to go up, the delta will go up as well. You go to 81, 82, 90, and eventually to 100 if the stock really goes up enough. So you're actually making more as the stock goes up. And contrastingly, if the stock was to go down, your delta will go down as well. That means you start to lose less as the market goes down compared to if you were holding stock. If the stock goes down $10, well, you will lose $10 on your stock as well. But in terms of LEAPS, it will lose lesser and lesser as it goes down. So if the stock goes down $10, chances are you'll probably lose maybe only 90, 80, or $70 out of $7 out of that $10 move down. So because of this, you have better risk to reward ratio. All right. So let's say if you have a stock, right? A stock at $100, the stock goes to $200. That means you make $100, and your risk is $100. Then your risk to reward is 1:1. But with LEAPS, your risk to reward is slightly better because your risk is $50, and if the stock goes up by $100, your profit is not $100, but you're very close to it because your delta by then should be around 90. So you will make $90 out of that $100 move. So if your profit is $90 and your risk is only $50, which is what you paid for, then your risk to reward is around 1:1.8. So your risk reward is much better just simply because you have already limited the downside by a significant amount. So there are also disadvantages of LEAPS compared to stocks, and it's always a trade-off. So like I mentioned before, you do not get dividends. So when the stock actually pays dividends, your option price will go down and you do not get paid for it. LEAPS also have a fixed lifespan, and that's the expiration date. So this is where it can get confusing for a number of people because at expiration you're not sure what exactly happens. So if your option is in the money at expiration, it will be converted to shares at your strike price. So for example, if the stock price is at $100 at expiration and your strike price is at $70, then you will get 100 shares at $70 per contract. But what happens if your option is out of the money at expiration? Well, it simply basically just expires worthless. So if the stock price is at $100 at expiration, your strike price is at $120, then your option will be worthless. Now, of course, before the option expires, you can keep rolling your option. If you roll your option, you will increase the lifespan. But each time you have to take note that if you were to increase the lifespan, you just roll it to a further expiration date, you will have to pay more extrinsic value. So you're just paying for more time to keep like the lifeline of your options going. So this is where you really need to understand what you need to do if you are buying a LEAP. The other disadvantage, like I said, you have to pay extrinsic value, which will decay over the lifespan of the option. That is why, as much as possible, I want to pay as little extrinsic value per day when it comes to buying options. This is the stock of Disney, and as you can see, it has dropped quite a bit. So at this time, you might be thinking to yourself, let's just imagine that you want to buy 100 shares of this stock. You think that, $102.72, this is a good place for you to buy, and you're looking to buy 100 shares. So there are two ways you can go about buying these shares, right? So option A would be to just simply pay $10,272 for 100 shares, all right? Now the second option would be to pay $5,490 for 100 shares. Now if it was you, which would you choose? Now you might be thinking to yourself, is this a trick question, right? Obviously, we would want to just buy just pay $5,490 for the shares, right? Why do I want to pay more when I can pay less? And this is the thing. A lot of people do not realize that there is an option B. Okay, they thought that the only way that they can buy, the shares, 100 shares, would be to buy, just pay outright, for 100 shares, pay $10,272, when there is in fact this other option. And this other options is by using LEAPS options, and LEAPS call options very specifically. So stocks are 100% intrinsic value. There's no extrinsic value at all. But for LEAPS, you have a mix of intrinsic and extrinsic value. And very quickly, extrinsic value is just basically time value. All right, time value, it decays over time. That means as the option expiration date goes to zero, all this extrinsic value will disappear. Okay, so if you take a look at this option chain down here of Disney. All right, first of all, I want you to take a note, to take notice of is the price is actually 102.60. This is the last traded, but we don't want to see this because right now, if you go to the market and you hit the ask, you can buy it for $102.60. So next thing I want you to take a look at is this intrinsic and extrinsic box down here. So you can see down here, there are two columns. On the left hand side is the intrinsic column, on the right hand side is extrinsic column. So intrinsic column, very simply, is just the difference between the current market price and the strike price. So if I was to take $102.60 minus off the strike, you will get 52.6, right? Extrinsic value, on the other hand, is dependent on the volatility as well as how much time that is left in the option. Okay, so that's what you need to know for intrinsic value and extrinsic value. So now let's talk about what if the stock goes up, right? The underlying stock goes up. How much does buying shares make, and how much does LEAPS make? So let's say if Disney goes from $102.60 to $122.60, what is the profit for stocks? So for stocks, very straightforward. We have a $20 profit, and then to calculate the return, it's just you take $20, you divide it by the cost per share, and you get 19.49%, which is not bad, which is pretty decent, right? What about for LEAPS? So for LEAPS, how do we calculate the profit? So basically, a rough gauge is by taking a look at delta, right? If you're not very familiar on what delta is by now, delta just basically measures the options value, the rate of change in the options value per $1 move in the underlying stock. So if the underlying stock goes up $1, right, and all else being equal, this option value will increase by 95 cents. And if the stock was to drop $1, then the option value would also drop by 95 cents. So basically, this is what delta measures. So in this case, if it goes up $20, we just take 0.95 times $20. That is a profit of $19. So how do we calculate the ROI? We just take this divided by the cost which we paid, which is 54.9, and we want to take a look at the mark box. Right, mark is basically just the mid price between the bid and ask, because if we were to take a look at the LEAPS specifically, you will notice that the bid and ask spread is pretty wide. So you never want to just go and buy off the ask column down here, because you'll be paying more than you need to, right? Because you can most of the time get it at the mid price. So we are taking the mid price, which is 54.9. So very simple and straightforward. You can see that if you're using stocks, your return will be lower than if you were to buy LEAPS. Now, what happens if the stock was to go down? All right, what happens to the price of both of them? So you can see down here, I've created this two little bar down here that measures, right, the intrinsic value as well as the extrinsic value down here. Now, this is something that I do not see any other people talk about. I do not see any other YouTube videos that are showing this change or this bar in terms of intrinsic and extrinsic value. So this is something that you probably only can see it here. All right, so this is very important for you to understand. So I want you to just pay attention for the next few minutes so I can explain this to you. So you can see that the stock is 100% intrinsic value. Okay, so the stock price right now, $102.60, that is the intrinsic value. Whereas for LEAPS, right, you only paid $54.90. So what this consists of is actually $52.60 in intrinsic value, and you're paying $2.30 for time value, which is the extrinsic value. So how do I know? You can just simply take a look at this column down here. You can see it says 52.6 in terms of intrinsic and $2.30 in terms of extrinsic. So this is all you are paying in terms of intrinsic. Okay, so it means that if the stock actually just drops to $0, right, stock, guess what? You lose an intrinsic value of $102.60. But for LEAPS, you can't lose more than what you paid, right? You already paid only $52.60 for your intrinsic value, right? So if the stock goes to zero, that's the most you can lose. So you do not even get to lose any thing down here, because you never paid for this value down here. Okay, so that is why LEAPS is a very good tool for reducing risk, because you are actually losing less if the market really goes to zero. The stock really goes to zero. Now, let's see what's the effect if the market actually drops. So if the market drops, or the underlying stock drops $10, the stock is very straightforward, right? You lose $10 in intrinsic value. You can see the value is lost here, and the remaining intrinsic value, this is not correct. This should be actually $92.60. Let me just change it here very quickly. So this is $92.60 because you have already lost $10. What about the LEAPS? What do you think is the value after the stock has dropped $10? All right. So if it drops $10, right now the stock will be worth $92.60. And the LEAPS will be $45.98. So why is this so, right? You see, when the stock drops $10, the intrinsic value portion of the LEAPS also lose $10. But if you notice, the extrinsic value actually gained $1.08. So the intrinsic value lost, but your extrinsic value gained. So how do I know this is the exact amount? Very simple. Let's say on the day itself. On the day itself, you bought the LEAP and the underlying stock dropped $10. You would take a look at the 60 strike price down here. So that's because, you see, if you were to buy at $50, the strike price, and the market drops $10, it means right now the LEAPS would be $10 closer to at the money. It'll be $10 closer to at the money. So this would be the value where the LEAPS would be at when it drops down $10. Again, assuming everything else, all else is equal, the volatility does not change. Okay, so you can see down here that the extrinsic value is $3.38, and then previously the extrinsic value was only $2.30. So that means it has gained in value. So instead of losing $10, right, just like the stock, you only lose $8.92, and the reason is because your extrinsic value has actually helped cushion the loss of your intrinsic value loss. So on the downside, the stock has no protection, but the LEAPS has the extrinsic value working for you. So many people think of extrinsic value as a bad thing, and most of the time it is, right, because it actually decays. But when the market actually drops very quickly as well, you will be actually losing lesser because your extrinsic value is helping you cushion the loss from any intrinsic loss of the LEAPS. So that's why you only lose $8.92 when you paid $54.90, right? Now, here's another question for you. What if the stock drops $60, right? We know that the intrinsic value loss will be $60 for the stock. Is very straightforward. You would lose $6,000, all right, per 100 shares. So there's a 6K loss. Now, what about the LEAPS? How much do you actually lose? Because if you see the value of the LEAPS, which you paid for, is only $54.90. You paid $54.90 and the stock dropped $60. So that is more than the value of the LEAPS. So what is the value of the LEAPS right now? Take a moment to just think about this. By the way, if you've enjoyed this video so far, I'd appreciate it if you hit the subscribe button and just give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. Okay, so have you come up with a guess on what's the value of the LEAPS after it dropped $60? Well, the answer is that the LEAPS did not actually go to zero. It actually still has a value of $11.10. So how do I know this? Basically, all you have to do is just take a look at the 110 strike price. That is because if the stock was to drop $60 and you bought a strike of $50, that means the stock right now is $42.60, your $50 strike will be out of the money, right? So it will be $60 down from this strike price. It will be down here, and again, all else being equal, you will see that the extrinsic value, there's still $11.10. There's still $11.10 left. It's not zero. So why is it that way? Well, again, that's because the intrinsic value, first of all, you can't lose more than the amount that you paid, right? You paid $52.60, even though if it drops $60 or it drops $100, you're only going to lose $52.60. So your intrinsic value becomes zero. Now your extrinsic value, on the other hand, it actually gains value. So it gains to $11.10 as you have seen here, right? So it has gained a value of $8.80 on the way down. So you can see again, the extrinsic value has come in to help you cushion this loss down here. So instead of losing the full value of the $52.60 in terms of intrinsic value, your extrinsic value helped you cushion that, and the total loss which you would experience from this LEAPS would be only $43.80, right? You bought it for $54.90. You only lost $43.80. Whereas for the stock, you have lost $60, which is $6,000. So here's the thing. When the market goes up, LEAPS make more than stocks. As you have seen, the return is higher. And as stocks drop down, you actually lose less because of this extrinsic value down here. This extrinsic value helps you cushion any loss that you made on this intrinsic value, right? And then it still gives you a chance, because if there's still time left and the market goes back up again, you will start to gain back intrinsic value. And of course, on the other hand, you will start to lose this extrinsic value. So it's kind of a little bit like a tango back and forth. But the key thing is that this extrinsic value can help you cushion on the downside. So on the upside, you make more because you are actually paying less. And on the downside, you actually lose less compared to buying shares outright because you have this extrinsic value to cushion you. So I hope you understand a little bit better about LEAPS and why this can be a very fantastic tool for you, especially if you look to get into that particular stock for a long period of time, about a year or 2 years or so. So you might want to consider buying LEAPS rather than just buying shares outright. Here is the risk profile comparing the 100 shares and the LEAPS option. So if you will take a look on the left hand side, this is for the stock. We will see three lines which I have put up down here. So we want to compare the losses and the profits to each other to see how it goes, right? So this is the first point, is at $50. So it's at $50, you see that it loses $6,500, right? For the strike of the 55 strike for the deep in the money call LEAPS option, we actually lose less, right? We lose $5,197. And you notice that there are two lines down here. There's this purple line and the blue line. So the purple line is basically the amount that you stand to make or lose today itself, right? Based on today, this is where the purple line, and over time this purple line will slowly start to conform to this blue line. Basically, it will go down to become this blue line, and the reason is because of extrinsic value. Extrinsic value will decay over time, right? So first off, right, you notice that as the market drops immediately, you actually do not lose your max loss first, right? And if you were to take a look at the max loss is $6,275, anywhere from $55 all the way to zero. That means you cannot lose more than that. Whereas for the stock, you see from this point on, you still can continue losing your money, right? That's because the stock, there's no cap to the downside. In a sense, you're going to lose your capital all the way down to the $0, where the stock goes to zero. Whereas for LEAPS, your loss is capped to how much you paid. So in this case, the max loss is $6,275. Whereas for this, if you paid $115 per share, 100 shares, you're going to lose $11,500. Now let's take a look if the stock actually went up to $100 or $150. So at $150, the stock makes $3,500, whereas the LEAPS only make $3,326. You can see it's actually not too much difference, right? You make slightly lesser, right? But it's not that much difference. Whereas on the downside, you only lose about half of what you're paying for this, right? 100 shares, you're going to pay $11,500, whereas for the LEAPS option, you pay $6,275. So that's slightly more than half. So that is why for the LEAPS, you have a capped downside, where the loss is really limited to about half, right? If you want to choose up to half of what you pay for the 100 shares. And then on the upside, you mimic very closely to about 100% of the profits that you make. So that's why the LEAPS can be a very great tool to help you grow your account. Okay, now let's take a look if the stock price is at $100. So at $100, you can see it loses very little compared to this. All right, this is about $1,500, whereas the LEAPS lose $1,358. So the whole idea down here, the reason why that you're not losing as much compared to when it's close to the expiration date, is because extrinsic value before it actually expires helps you cushion your loss as it goes from in the money to at the money, right? You notice down here that the gap is the greatest down here, right? Remember, your strike price is at 55, so at 55 is around here. You notice your gap is the biggest down here, whereas when it's in the money down here and out the money down here, the gap is the least. And the reason is because of how the extrinsic value actually expands as it goes to at the money. So let's say, for example, this is where you bought the LEAPS, right? So you will buy the LEAPS. Let's say we use the example of 55 LEAPS. So right now the stock, right, is at $100, okay? And then you bought the LEAPS of a 55 strike. So at this point of time, it is very deep in the money. It's considered in the money. So this is where your extrinsic value lies, right, at this point. Now, as the market goes up, let's say the market goes to $110, right? Let's say it goes to $110, your extrinsic value starts to actually decrease, right? Because it becomes even more deeper in the money. So in this case, you gain intrinsic value, but you lose extrinsic value, right? Now let's take a look about what happens on the other side. Now, as your strike becomes at the money, that means as this stock from $100 drops to your strike price of $55, you notice that the extrinsic value actually gained, right? While you lose in terms of your intrinsic value from the stock drop in terms of the price, you actually make money in terms of your extrinsic value. Your extrinsic value gain in value to help you cushion the losses that you made on the intrinsic value. Now, as it goes further down, right, if it drops below $55, of course, slowly your extrinsic value will start to drop as well. So you can see this is the bell curve, right? So as the market transitions from in the money to at the money, you make the most extrinsic value gain. But as it drops even further until it's out of the money, there's almost no value left, right? Your extrinsic value also basically almost goes to zero as time passes as well. So what this means is that as the market drops, you actually have some protection because your extrinsic value comes in to help support you. So I'm going to show you the option chain right here so you can really see. If you can see this option chain down here, this is the deep in the money 55 strike. You notice the extrinsic value is $2.80, right? And as you get to the at the money of where the stock is right now, around $110, you notice that it becomes much thicker, $17, $19. You can see that's why this is a bell curve, right? You can see that the extrinsic value becomes the greatest at the money, right? And in the money and out the money has the least. So what happens, like I mentioned before, your extrinsic value will actually help you cushion the losses as you lose money on the intrinsic value, right? Okay, intrinsic value is just the difference between the strike price and the current price of the stock, right? So as the stock goes down, you lose intrinsic value, but your extrinsic value will start to gain to help you cushion that loss. So the role of extrinsic value can be actually positive for you as you're losing money, right? But don't forget that extrinsic value will still decay to zero over time. Now, I want to show you the graphical representation in terms of the value so you can understand a little bit better how this extrinsic value actually comes in to help you when the market is dropping, right? When the stock you're choosing is dropping. So down here, this is the stock price, right? Imagine the stock went up and come down this retracement. You say that, all right, I want to go ahead and buy at this price, all right? So we will compare two things. We will compare 100 shares and we'll compare buying the deep in the money call LEAPS, all right? So this is the strike price for the call LEAPS, right? Because we buy deep in the money, it will always be below whatever the value of the stock is right now. So let's say the stock value is at this price. You can see this is the full intrinsic value. So I've marked the bar to match the intrinsic value of where the stock is. So let's say if the stock is at $100, then your intrinsic value of the stock is $100. Now, whereas for the deep in the money call LEAPS, you notice that you're actually only going to be paying up to where your strike is, right? So let's say, for example, if this is the 50 strike price or the 55 strike price, you're only paying the intrinsic value from where the current stock price is to the call LEAPS strike price. So you're only paying this much in terms of intrinsic value. And don't forget, we also have to have extrinsic value because we're paying for time value. So this is the extrinsic value portion of the call LEAPS. All right, so let's take a look at how it actually goes when the stock goes up or down. So now let's say the stock goes down, right? So it dropped this much in terms of intrinsic value. So if you were to see, I've also color coded the bars to match the intrinsic value loss. So if the shares, or rather the stock, drops by, let's say, $25, your stock intrinsic value will drop by $25. Your call LEAPS intrinsic value will also drop by the same amount, right? It drops by the same amount by how much the stock drops, right? That's intrinsic value. Now, what about the extrinsic value? You notice that the extrinsic value actually gained, right? You see, if you compare the one before, right, intrinsic value dropped, but extrinsic value actually gained. So instead of losing this much, right, you are being actually cushioned. Your loss has been cushioned by the gain, by this part of the extrinsic value that gained in value. Okay. Now, what if the stock goes up? Now, if the stock goes up, right, as you can see, now this is the additional intrinsic value gain. So on your call LEAPS, you actually gain the same amount in terms of intrinsic value, right? But then your extrinsic value actually drops, right? It decreases, right? You see, before, your extrinsic value is this amount, but because the stock went up, although you gain in intrinsic value, your extrinsic value reduces a little bit. So your gains are a little bit muted, a little bit decreased, because these gains a little bit offset by the loss that you made on the extrinsic value, which is not much, right? So this is what happens when the market goes up. Now, what happens if the stock suddenly crash and it crashes past your call LEAPS strike price? So this is what happens, right? So for the stock, intrinsic value is very straightforward. You lose whatever intrinsic value from where the current stock price is to where you first bought it at, right? So this is how much you lost, right? Whereas for the call LEAPS, you notice that you cannot lose all the way past here because you only paid your intrinsic value up to this point. So your intrinsic value, you already lost everything. You only can lose what you paid in terms of the intrinsic value. You cannot lose more than that, right? So that's the beauty of the call LEAPS, is because you also kept your intrinsic value loss. Now, on your other hand, right, your extrinsic value actually gained in value. You notice it gained so much in value to help you cushion the loss of this intrinsic value. Again, you see, if you were to compare at where you first bought it, you see, when we first bought it, your extrinsic value is this much, your intrinsic value is this much, right? But when the stock crashed below your strike price, look at this, your extrinsic value has actually expanded that much, right, to help you cushion any losses here. So you do not have the full impact of the losses from this intrinsic value. So again, that is why the LEAPS, the call LEAPS, the money call LEAPS, has this protection against the stock crashing through the form of your extrinsic value expanding. Whereas for stock, there is no protection whatsoever. Whatever you lose in terms of the price is what you lose in your stock's value. All right, now let's say, for example, the stock climbs back up to exactly where you bought it, right? Where you bought the strike at, where your stock is at, right? So the stock, you can see the intrinsic value goes back to where it originally was. So at this point in time, you do not make money, you do not lose money, right? But what about the dip in the money call LEAPS? You notice that the dip in the money call LEAPS, right, your intrinsic value has been reinstated to the same amount as when you first bought it. But your extrinsic value actually decreased in value. Why? That is because of time, theta decay, right? You see, at the beginning when you first bought it, your extrinsic value is this much, but after some time, right, the stock price goes back to the same, but now your option value, your dip in money call LEAPS, is actually now worth lesser than when you first bought it because of this extrinsic value. So while extrinsic value actually helps you when the market is going down, don't forget that it is actually still decaying over time, right? It's slowly decaying and slowly picking up speed as lesser time is left in the expiration of the option. This is the theta decay graph. As you can see, that the theta decay, right, is the least when there is a lot of time left in the option, right? And it really starts to pick up speed around the 45 days mark, right? You notice that around the 45 days mark, the curve starts to become much steeper, and it becomes even more steeper as it goes to zero. So as an analogy, right, I like to compare this as though like you are holding an ice cream, right? You are eating ice cream, and the ice cream will melt over time, right? If you don't eat it, you just leave it there, it will definitely melt because of the weather. Now, there is a difference in terms of weather by the number of days left to the expiration. So the longer days there is left, it's like you're eating ice cream in winter, right? Does it melt? Of course it will melt, but it melts very, very slowly, right? It melts very slowly. But as it gets closer to the expiration date, right, suddenly now you're no longer eating your ice cream in the winter. You're starting to eat it in the hot summer. So as it gets closer and closer, the temperature becomes hotter and hotter, and that's where it starts to melt very quickly. So the theta decay is not uniform, right? Your extrinsic value does not decay uniformly. It's not the same amount every day, but rather it starts off very little, and it starts to really pick up speeds towards the end of the expiration of the option. So if you will take a look at the option chain, you can see it very clearly down here, right? So if you take a look at the 537 days to expiration down here, you notice that the theta decay, right, this column down here shows that you're only losing 2 cents a day, right? You're only losing 2 cents a day. But as you get closer to the expiration, right, you see this is 19 days left, you notice that the theta decay becomes 9 cents, right? And here's the interesting thing. You see, you notice that you actually have very little extrinsic value left. So by logic, if you have very little extrinsic value left compared to if you have a lot of extrinsic value left, the theta decay should be more here, right? But instead, it's actually more as it gets lesser. And again, that is because of this graph down here. It really picks up speed only closer towards the expiration date. So that is the reason why we always want to go for the furthest days to expiration for the option, because it gives us the least theta decay, right? It gives us the least theta decay. This way we have much more time for the option to be right. So that's the main reason why I want to go for a very long dated option, right? The other reason is because when you buy the long-term expiration, you notice you actually have it cheaper, right? You buy it cheaper. It's almost like a bulk deal, right? If you were to buy something, right, in bulk, it's always cheaper when it comes down to the cost, right? Let's say if you buy maybe a bottle of mineral water costs you $1. But if you were to buy 10 of them, it may cost you $5. So the cost is 50 cents for one because you buy in bulk. When we come to buying extrinsic value, right, it's the same, right? You notice that it's actually much cheaper if you buy in bulk. So how do we know? We can just calculate this. Okay, let's just take a look at the 110 strike price. How much do we pay per day for extrinsic value? So we just take 1.705, all right, which is the extrinsic value we're paying for here. We divide it by 19 days. So we're paying roughly 8.9 cents. So let's round it off. That's 9 cents per day in terms of extrinsic value. But what about this? So we take $17.105, same strike price, and then we divide it by 537 days. Look at that. So we are only paying 3 cents, right? Whereas if you bought the 19 days to expiration, you're paying about 9 cents. So that's 3 times more. So that's also the reason why we want to go for the longest dated option, because you get it the cheapest in terms of per day, the extrinsic value which you're paying per day, plus your theta decay is the lowest. So that's the reason why for long-term investing, we always want to go for the longest dated ones. Okay, so let's take a look at some pros and cons of owning stock versus buying deep in the money call leaps. So the pros for the stocks is that there's no expiration. So this is very straightforward and easy to understand, because this way you don't have to worry about, you know, the option expiring because there's no expiration date. So you do not have to worry about how to roll or when to roll, right? Unlike deep in the money call leaps, you do have to worry about rolling and know how to roll when it gets closer to the expiration date. Now for stocks, it's 100% intrinsic value and there's no extrinsic value. So you do not have to worry about theta decay in this sense. And for stocks, you can receive dividends. Now, whereas for deep in the money call leaps, you have limited downside. And because of this, right, you have lesser capital at risk because you can put up, as little as 50% of the cost you will put up for 100 shares, or you could go slightly even lesser if you want to have a lesser delta. But basically, you will have much lesser capital at risk compared to stocks, because stocks you have to pay the full value of 100 shares. Now, with deep in the money call LEAPS, you also have higher returns, because your returns, as you have already seen in the P&L graph, the profits is actually very similar to stocks. Now, the difference is that we have lesser capital at risk. So if we were to divide it by the amount of capital which we put up for the call LEAPS, our return is actually higher in terms of percentage. And there's also dynamic delta, right? So we've seen that dynamic delta means the delta moves as the stock moves. So if the stock drops, the delta will actually drop as well, which means you start to lose lesser as the stock drops. But on the way up, the delta actually increases. So this way, you make more as the stock goes up. So extrinsic value in the deep in the money call LEAPS actually also help to cushion losses as stock drops, right? So as we have already seen, there's this bell curve, right? So this bell curve, we always start off with the in the money over here, right? So we are buying the deep in the money call LEAPS. So this is the value of our extrinsic value which we have purchased. Now, if the stock is to drop, our in the money will start to shift to at the money. So at the money, this is where the extrinsic value is at its highest. So that is why we are able to cushion some of the losses, because although the intrinsic value we have lost, we have actually gained in our extrinsic value, and that helps offset any losses in the intrinsic value. All right, let's take a look at our cons. Now for the stocks, we have more capital at risk because, as I mentioned, we have to pay up a full, the full cost for 100 of shares, and because of that we have lower returns, and there's no extrinsic value to cushion the loss. So in a sense, there's no protection to the downside in the form of extrinsic value for stocks, right? Now for deep in the money calls, although extrinsic value helps to cushion the losses as it drops, you must remember that there's also the theta decay. That means as it gets close to the expiration date, it will start to lose its value and ultimately become zero at expiration. So you must always keep this in mind. So when it gets closer to the expiration date, this is where you will need to roll. And when you roll, you will need to add capital to extend the LEAPS life, right? You add in capital, that also means that you're increasing the risk, the overall risk to the call LEAPS, right? So let's say, for example, if you bought the call LEAPS, let's say you bought it for $10, so $10 will be $1,000. Now, if it's getting close to the expiration date, right, you want to roll it. So as you roll it, you might need to top up maybe another $2 for it. Right, so if you were to top up $2, now your total risk on this call LEAP would be $12, which means if the stock, let's say touchwood, does go to zero, you lose an additional $2 on top of the $10 which you've already put in. So this is something to keep in mind when you're getting into, or when you're buying deep in money call LEAPS. And finally, there are no dividends for options, right? So that is why it's always better to use it on non-dividend stocks. So I would rather use this on like tech stocks, because they do not really pay any dividends, or if they do, they pay very little. So this way, right, you do not lose out on any dividends because they don't pay out any dividends in the first place.
First of all, I want to get into how this LEAPS actually fit into our portfolio, right? So whenever we are trading options, or at least in my case, I like to see it as a well-rounded options portfolio. That means to say that I want my portfolio to have different option strategies, right? So some people, when they approach options, they might only trade one type of strategy. I don't do it that way, right? I like to put on different type of strategies, so this way, regardless where the market goes, I will always have some positions that actually capture it. And the key here is that they are all on different timelines, right? So the beauty about trading options is that you can actually choose the DTE that you want to put on the option strategy on. So they are not all on the same timeline. So it is possible that you have a bullish strategy, neutral strategy, and a bearish strategy on at the same time, and they all can be profitable at different times. Well, of course, they are not always going to be profitable in the sense whereby trade by trade is going to be 100% profitable, right? That is not possible. But rather, we want it in a sense whereby overall, each individual strategy can be profitable in the long term, but they are just going to profit at different times, right? Different stages. Again, they have their own timelines. So the way that I do it, as you can see, I have bullish strategies. So in case if the market goes up, I can still profit from, bullish option strategies. And if the market just stays somewhere in the middle, this is where you have your neutral strategies, right? These neutral strategies will profit from what's called the expected move. And then finally, if the market goes down, I want bearish strategies as well. So if the market goes down, hey, at least I have some option positions that can actually benefit from the market going down. So for this video, we're really going to be talking mainly about these bullish strategies down here, because that's where the LEAPS fit in. Now, some of you might be going, hey, is there any necessity or real need to actually trade this LEAPS? But the way when I talk about LEAPS, I'm talking about call LEAPS down here, where we participate in the long-term, upward movement of the overall market. So some people might be familiar with this strategy called the bull put spread. So the bull put spread is the put credit spread. Now, you can definitely put on these strategies, and I also do put on these strategies, but at the same time, I also want LEAPS. And the main reason is because when you put on put credit spread, what you notice is that you actually have limited upside, right? That means to say if the market keeps going up, and as you know, as of this recording at least, the market has kept continually going up. So if you have this put credit spread, what you'll find out is that, you miss out on quite a lot of the up move because your profits from selling this put credit spread is pretty much limited, right? And if the market keeps going up, then it's going to be a little bit difficult psychologically for many people to put on a put credit spread as it keeps going up, right? Usually you want to wait for a retracement or a reversal, but sometimes that doesn't happen, especially when the market is going up very strongly. So what is the solution here? That is to also have LEAPS in your portfolio. So that's where, for me, LEAPS come in, right? This is where it solves the mid to long-term positive deltas, whereby if the market keeps going up, hey, I am still in the market. And it is a very great way as a stock replacement strategy, because if you were to put into stocks, then stocks is going to quite, take up a little bit of your capital, and your return won't be as good, right? Because it's not really a leverage tool compared to LEAPS. Now, of course, if it's leverage, there's always a double-edged sword. You need to know how to use this leverage well. And that's what this strategy is also all about. So now let's get into the strategy for how I trade LEAPS. Now, my strategy is actually pretty simple, and it involves only 3 steps. So the very first step, and it's the one that is the most paramount to making this strategy work, because if you think about it, this is a bullish strategy. So stock selection is pretty important, right? Choosing the right underlying, if it doesn't go up in the long term, then no matter what kind of a strategy you put on in terms of options that is bullish, it's not going to make money. So when it comes to finding the right underlying, there are 2 ways, right? The first, you can go for fundamentally good stocks. So for me personally, what I think are fundamentally good stocks are Google, Microsoft, Meta, Amazon, so on and so forth. And these are the stocks that I personally have been trading and has been doing well for me. Now, that is not to say that you should do it as well. Again, you want to do your own due diligence. For me, the way I classify fundamentally good stocks, at least one of the important criteria is that it has increasing revenue and increasing profits, right? Increasing year-on-year revenue as well as profits. This way, you know that this company is doing well. Remember, every stock that we are choosing to trade, they are actually company, right? They are a company. That means to say their balance sheets, they're selling something. So naturally, if you want the stock to go up over the long term, at least most of the time, this company has to be doing well, because if the company is bankrupt or is always losing money, then the chances of it going up in the long term is not that high. So again, choosing fundamentally good stocks is paramount for this strategy. Now, if you're not very good at finding fundamentally good stocks, you can go the much more simpler way, and that is to find this positive drift index ETFs, right? I call this positive drift index ETFs because you want to find the broad-based ones whereby over the long term, it just wants to go higher, right? It just wants to keep going up, right? Not all index ETFs are built the same. This is very important to understand. So for example, what are the positive drift index ETFs? Well, they are your most common ones like your SPY, QQQ, IWM, XLK, so on and so forth, right? There are quite a number of them. So there are quite a number of choices that you have. But as long as you stick to either of these 2, Do not go for those whereby it's a meme stock. These are stocks where likely are just meant for trading rather than doing it for the long term. So remember, for LEAPS, we want this more to mid to long term. If it goes up, you profit. So step number 2, this is where we get into the details of choosing the exact options, right? So basically, we're going to go for long-term ones. That's why it's called LEAPS. I look for the one that's above 365 DTE. Some people prefer shorter, some people prefer much longer. Hey, this really comes down to you, but I'm going to explain to you a little bit why later on when we go inside the option chain, inside my trading platform. I'll explain to you why I want to go for a longer DTE, because it's actually going to benefit our strategy. And next, we want to also go for higher deltas, deep in the money options for this strategy. And again, let me explain this later on when we get to the option chain. And finally, step 3. So step 3, this is where you either choose to continue putting on the trade, right? If you want to continue, you roll it, because remember, options, they all have expiration date. If you come to the end of the DTE, you need to know what to do, right? Are you going to continue the trade, or are you just going to close it out and take, whatever profit there is, right? So we want to do this roughly around 90 to around 180 DTE left. And the main reason is because of the extrinsic value. So extrinsic value, basically, it's what I call air, right? It's the air value of the options in a sense, because over time, once the DTE goes to 0, your extrinsic value also goes to 0. So that is why when we are placing our trade for the LEAPS strategy, we need to be very mindful of this EV. Okay, so let's head on over to my trading platform, and I'm going to show you more into detail how to execute this strategy. Okay, so we are in my trading platform. This is my live trading account at Thinkorswim, as you can see over here. So you can see over here that I have a position on, which is Meta, right? Meta, to me at least, I think it's one of the more fundamentally sound, fundamentally strong stocks, which I have a LEAP option on. I actually have a few. I sold some of them away already as the market kept going up. So this one I just kept around, just to see how much I can get. So as you can see down here, this is a LEAP option, and the profit on this so far open is about 33,000. So here is the good thing about LEAP when it comes to comparing it versus stocks, and that is the cost, right? Because with stocks, you have to pay up the full amount, but whereas for LEAPS, you only have to pay, a part of it, a fraction of it, right? Because you have that leverage. Now, how much you actually want to pay for it really comes down to you and how aggressive, but I'm going to show you a guideline, roughly, where you want to choose this option. So why LEAPS are an important part of our options portfolio is because for the long term, as the market goes up, as you can see in this P&L graph down here, there is no cap, right? It can just keep going up and up and up. And as long as, the stock keeps going up over the long term, you can still keep profiting. So this leverage that you have can be quite good. So as you can see down here for Meta, my cost on this particular LEAP, as you can see, is only $4,000, and my P&L open as of now is 33,000. So it's pretty decent return. Now the other underlying that I talked about earlier was the index ETFs, right? So another one that I like to put on is QQQ. So as you can see down here, this is QQQ, where I have 6 call LEAPS down here, and as you can see down here, the cost is about 66,000, but my P&L open is already $86,000, which is more than 100%. So generally, when you want to get this kind of return, it's a little bit harder with stocks, but with LEAPS, you can actually increase this return because of the leverage that you get, right? So I want to get into exactly how you're going to choose the right LEAP for this strategy. So what we're going to do is we want to go over to the option chain. So let me just go over to the option chain over here. So this option chain down here, you notice that there are many days. So as you know, for LEAPS, we want to go for long term. So this one, when I put it on, was much further out, right? I think it was roughly about 400 over odd days, almost 500 days. So pretty much similar to this one. So what we're looking at really is all this DTE down here, which is more than 365. As you can see, you can even go all the way to 1,029 days. That is if you want. But of course, one thing you need to know is that as you go further out, it's going to be much more expensive. Why? Because extrinsic value is equal to time, right? So basically, the more time you have, the more extrinsic value you have, which means to say you have to pay more for that position. right? So for this, let us just go to the 483 days one down here. So the one that we want to go for, I want to go all the way to roughly around 80 deltas, right? 80 deltas down here. So as you can see down here, we have a number of selection. Let's say if you go all the way from 80 to 90 deltas, you can find, this LEAPS option down here that is still going to be cheaper than if you were going to buy this stock outright, right? The stock right now, as you can see, is $438 for one stock. If you buy 100 stocks, that's going to cost you about $43,000 over dollars, right? So if you don't really have that much money, or you don't want to put too much in terms of cash into the shares, then LEAPS is going to be a very good choice for you, because as you can see down here, if we go to around 80 to 90 deltas, let's say for example, if we go to the one at 80 deltas down here, 0.8, if you were to just click on the ask down here, you notice it's only $83, or rather $82 in terms of the mid price. So how much is this? It's actually only 8,000 plus. So if I was to click review, you notice that the cost of this is only $8,300 plus dollars. So you are controlling 100 shares for only $8,000 plus, when the cost should be around $43,000 odd dollars. So this is the kind of leverage that you can have. Now you might be wondering, hey Davis, what if I go further out in the money? Let's say for example down here, you can actually get it for much cheaper, right? So let's say for example, if you choose this one down here, you can actually buy it for only $5,000. So $5,000, let me just show it to you. So you pay $5,000 to control a stock that is roughly worth $438. You have control 100 shares of that. So you have immense leverage, and it's pretty cheap for you to put on this strategy. But what is the issue with this down here? Now, the issue with this is that this is all extrinsic value. So you can see that there are two columns down here, right? The column on the left down here says intrinsic value, and the right side says extrinsic value. So remember, extrinsic value is basically the value of just time, which is basically air. You're paying a premium where the option does not have any intrinsic value. So as you can see down here, the intrinsic value is 0. So which means to say, if the market just stays still, does not move at all, you actually lose all this money, right? Let's say, for example, you hold all the way to expiration, 483 days later, it's at the same price, you're going to lose everything down here, right? So this is the very important key to understand when you're trading this LEAPS strategy. And that is that as much as possible, we want to buy the LEAPS that has less extrinsic value, because extrinsic value is going to go down over time. Remember, when it reaches 0 DTE, extrinsic value will go down to $0. So this is very important to understand, and that is why as much as possible, I want to choose the option that has very little extrinsic value and more intrinsic value. So that is why we want to go all the way to roughly around 80 DTEs, right? 80 to even 90 DTEs. So you notice down here, once you go to the 90 DTE, now you're paying much lesser for this extrinsic value. So when you have a lesser extrinsic value that you're paying for, because remember right now we are buying options, right? We are not selling premium, we are buying premium. So when you're selling premium, you want extrinsic value to be as high as possible, because you actually make from this decay of this extrinsic value. But when you're buying it, you want to buy it as little as possible, so that you have as little decay as possible. So how do you know how much decay is it actually having? This is where the theta column comes in, right? So let me just delete all these drawings first. So you can see over here, this is where the theta column is, and this tells you, what is the theta decay roughly every day, right? As you can see, the lesser extrinsic value there is, the lesser decay there is. The more extrinsic value there is, then the more decay there is. So basically, you're actually pretty much fighting against time when you have more extrinsic value. So that is why our goal is to go for around 80 to 90 delta. So let me just bring back the column again, if I can find it, which is somewhere around here, right? So 80 to 90 should be somewhere around here. So one thing is that as your delta gets a little bit higher, the cost of these options actually becomes a little bit more expensive, right? As you can see down here, this costs roughly about 114 on the ask, whereas over here at the 80 deltas, it costs only $83. So it's a difference between 11,400 and 8,700. So this comes down to your own risk allocation, right? Your capital allocation. But generally, if you stick to around 80 to 90 deltas, you're good. Now, over time, as the market continues to go up, provided you choose the right underlying, of course, then here's what's going to happen, right? Your theta is actually going to start to go to 0. So as you can see down here, my position on this QQQ over here, this 6 LEAPS that I have reached a point whereby the delta has reached 100 on each of them, right? That means it's really deep in the money right now. So at this point of time, I'm essentially pretty much like I'm holding a stock position, but it's a leveraged one because the cost that I put up for is much lesser than if you were to buy the stock outright. And at the same time, there is no theta decay, right? And my profits is now roughly about $1 movement is $1 profit, right? So delta also tells you how much you actually make per $1 move. So if your delta is 80 cents, right? 0.80, let's say for example, we go to this one, it just means that every dollar move in the underlying, that means QQQ, let's say it goes from 438 to 439. If you own the stock, you'll be up $1. But because you're using options, this delta tells you that you have an 80 cents gain on this option. So for every $1 move in the underlying, you're getting a profit of 80 cents in the option, right? A gain of 80 cents, which is about $80, right? So how did my option actually reach 100 delta, right? 100 delta because I have 6, so it becomes 600 deltas. So how did it become 100 delta from 80? Well, basically, as the market goes up and up and up, this delta down here becomes higher and higher because the strike price now slowly starts to become more and more deeper in the money. So that means to say, as the market goes up, you're going to start to make a little bit more each time, right? As it goes higher and higher, you start to make even more per dollar move until finally you reach the point where it becomes 1:1. As you can see down here, here becomes pretty much 1:1 move. Now this works on the upside, it also works on the downside. But here's the cool thing on the downside, right? On the upside, as the market goes up, you start to make a little bit more each time as the market moves up per dollar move. But on the way down is the opposite, because as the market comes down, your delta starts to drop as well. So when your delta drops, it just means that as the market goes down, you start to lose lesser and lesser and lesser each time. And here's the cool thing. Although your intrinsic value starts to drop as the market starts to go down, your extrinsic value actually starts to go up. Can you see down here? You can see that the extrinsic value starts to increase as this delta starts to decrease. So what this means is that you actually have a very nice cushion when the market drops, right? When the market drops, if you're holding on to stocks, hey, you're going to lose, for every $1 drop, you're going to lose $1, right? For each share that you're holding. Now, for options, it's slightly different. So as it goes down, you no longer start to lose even more, but you're going to start to lose even less, and mainly also because extrinsic value starts to increase as the market drops. So this is step number 2. We want to choose roughly 80 to 90 deltas and go for the DTE that is more than a year. Now the final one is, what do you do once you have reached close to around 90 to 180 DTE? So I use that as a guideline for us to either roll or close, is because theta starts to decay rapidly as it gets closer and closer to the expiration date. Now, given that, let's say, for example, your positions still have quite a bit of extrinsic value, that means the market hasn't really gone up a lot just yet, then this position that you have, the value is going to start to erode pretty quickly towards the last 90 days, because that's when the theta decay really picks up. So at that point of time, this is where you need to decide whether you want to close out the trade or to roll further out in time. So I'm going to use this as an example down here. Now, there's still 329 days left, so I'm not really going to touch it just yet. But let's say, for example, it's going to be around 180 days or maybe 90 days left. This is where I want to start to roll it. So how do you roll it? You just have to click roll, and then this is where it's going to show you your options, right? So as you can see down here, when I roll this, what I'm doing is that I'm selling away this 329 down here, and then I'm buying the one at the further out date down here. So now the key thing down here is you want to always reposition it back to around the 80 to 90 deltas, because that's where we started it off. So if your position is going to be roughly at around 50 deltas at the point of time where you roll, then this is where you have to actually put up a little bit more capital to bring it back to 80 to 90 deltas. But if your position is already very deep in the money like mine over here, then when I change it to roughly 80, 90 deltas, you're going to see that I'm actually going to get a profit, right? So let me just see what is the 80 to 90 deltas here on the 483. So let's say, for example, this is the 483. Let me just check. Yep, this is 483. So I am going to go to 80 deltas at 394.78. So down here, what I'm going to do is I'm going to sell my existing one, and I'm going to change this strike to around the 80 delta one, which is 394.78. So if I go to 394.78, now you'll notice there is a minus 172, which means to say I'm getting a credit for rolling this. Why? If you think about it, rolling is pretty much just closing out your existing position and then putting on a new position. So rolling, in this case, what I'm doing is that I'm closing out my profits already, and then I am resuming the trade by buying the next leap at around 80 to 90 deltas, which costs much less. So as you can see down here, if I was to click review, you can see that immediately I'm going to get a credit of $103,000 to put on a new position. I'm going to be sharing with you a simple yet highly profitable LEAPS strategy that you can use on QQQ that has already generated me over 6 figures. So first of all, why did I decide to choose QQQ over the other index ETFs? Well, the reason is actually pretty simple. It's because in terms of performance, QQQ actually does the best amongst the other main major index ETFs. So for example, this is the QQ here, as you can see. Now I'm using Yahoo Finance, so you can definitely just go to Yahoo Finance and see this same page as well. So if you was to go to the performance tab over here on the left, and you go down to this trailing returns over here, you can see all the past returns in terms of the number of months and years. So if you will take a look at the 5-year return of the QQQ, you can see that the return is about 19.93%, which is pretty close to 20%, and the 10-year return is about 18.29%. So this is the average return over the past 10 years. So 18.29% is actually not too bad. Now, if I was to compare this to the other index ETFs, you will notice that this return is actually better. So if you was to compare this to SPY, as you can see over here, this is SPY. If you go to the 5-year return, you can see that the 5-year return is only 14.44%, and the 10-year return is 13%. So QQQ actually did better in terms of the performance compared to SPY. And what about for the other index ETFs? If I was to compare this to Russell, then you can see that the Russell really pales in comparison, right? As you can see over here, RWM, the past 5 years is 7.28%, and the past 10 years only 7.76%. So the QQQ really overshadows the RWM performance. And finally, the last of the few major index ETFs will be the Diamonds. So Diamonds is the Dow Jones Industrial Index. So if I was to go down here as well to see the returns, you can see that the 5-year returns about 10.39%, and the 10-year returns is 11.4%. So as you can see, out of all the major index ETFs, QQQ has the best performance. So that is why I want to use the LEAPS strategy on QQQ. So this LEAPS strategy, which I'm going to be sharing with you today, is a very simple one. And basically, it's a form of a stock replacement strategy. That means instead of buying QQQ outright, instead we buy and hold QQQ, we're going to sort of invest into the QQQ LEAPS, where we simulate a position of buy and hold. So how do we do that? So it's going to be a very, very simple strategy. So the strategy just involves 2 steps. So I'm just going to very quickly just show you the 2 steps that you need to do for this strategy. So the very first step is to just buy a dip in the money call LEAP that is about more than 1 year in terms of the DTE. So I want one that is very long dated. And the reason why I want one that is very long dated, because that's where the theta decay is not going to be as high compared to if you were to go for a lower DTE. So as you know, the theta decay is exponential. As it gets closer and closer to the expiration date, that's when the extrinsic value inside the call option, in this case the call LEAP, is going to start to decay very rapidly. So to reduce the effect of this decay, we want to go to very far out in terms of time. So that's why I choose roughly more than a year. And the second step basically is to just roll at around 60 to 90 DTE. And where do you roll it to? Basically, you just roll it back to step number 1. And all you got to do is just keep doing this. So the whole idea with this strategy is not to trade it in a sense where you're just trying to capture, profits here and there and hopefully try and avoid the losses when QQQ make a loss. So this is not that strategy. This strategy basically is to mimic the performance of QQQ but using a leverage tool, which is options. So we're going to use the call LEAPS to kind of leverage the returns that we get on the QQQ. So what that means also is that if I was to go back to this table over here to see the annual total return, for example, if QQQ did 25.5% in 2024, what it means is that with LEAPS, you should generally get a higher return compared to this 25.5% if you do it the right way. Now, same thing for 2023. So if QQQ did 54.85% in 2023, with the LEAPS strategy, you can get a higher return. Now, one thing you need to know is that with this LEAPS strategy, you're actually enhancing the performance of the underlying. So in this case, if it's a positive, you enhance the positive return. But if it's a negative, for example, in 2022, you'll be enhancing the negative returns as well. That means to say your performance using LEAPS in 2022 will be worse than 32%. So that means you'll be down maybe more than 32%. So this is how the call LEAPS work, or rather this LEAPS strategy is meant to do. It just enhances the performance. So that is why for the LEAPS strategy which we're using, you want to use it on positive drift vehicle where you know that in the long term, it will want to just keep going higher. If you use this on individual stocks, then the risk really is on you, because if the stock actually do not go up over the long term, it keeps going down, then you're going to lose a lot of money. All right, so the next thing that I want to talk about is this deep in the money call LEAP down here. So deep in the money, how deep do we want it to be? So when I talk about deep in the money, I'm really talking about somewhere around 90 deltas. And that is because when you are buying options, you have a very big enemy. You have a very big nemesis, and that is the extrinsic value. So when you are buying options, this extrinsic value down here is your kryptonite. Because as you can see over here, this is the delta of the options. So what you'll notice is that the higher the delta, the lower the extrinsic value. And the lower the delta, as you can see as I go to the lower deltas, you will see the extrinsic value finally pick up. So this extrinsic value down here, this whole column here, what it just means is that whatever value you see here will go to 0 once this option expires. So the whole idea down here is that when I buy the option, I want to have as little extrinsic value in the option as much as possible. Now, this is the opposite when you're selling options. When you're selling options, you want to have as much extrinsic value as much as possible. But when you're buying options, it's the opposite. So when you go for deep in the money, for example, 90 deltas down here, you can see that the extrinsic value is about $20.81. Now, if you were to compare this to something that's at the money, so let's say, for example, if I was to choose one down here, let's say 60 delta, you notice that it's $52.38. Now, for the option price itself, this is much cheaper, because if I was to buy this option, it's only $53 on the ask side. But if I was to buy the 90 delta option, you can see over here, it's going to cost you $164.47. So in terms of actual dollars, that's about $16,000 per option contract, because each contract controls 100 shares. So as you can see over here, let's say if the QQQ after the end of the life of this option, so as you can see over here, I chose about 373 days. What that means is that if QQQ do not move from its current price, so as you can see, the current price is about 515 as of this recording. If it does not move from this price at expiration, what is the final value of this option? Well, the final value is basically what you purchase for minus off this extrinsic value down here, because extrinsic value goes to zero. But what remains is the intrinsic value. Intrinsic value does not decay. So in this event, whereby the market did not move at all you lost is $20.81 out of the $164.47 that you bought this call dip for. Now, what about the at the money option? The at the money option would be slightly different, because right now we had bought this one, which is out of the money, right? As you can see down here, this line down here denotes whether it's in the money or out of the money. So this option strike down here is out of the money, which means to say, once it reaches expiration, all this extrinsic value is all gone. And because QQQ did not move at all, or rather it went back to the same price at the end of this life of this expiration of this option, basically your option is now worthless. So you had paid $53 for it, now it's zero. So that is why whenever we are buying call dips, we always want to go as deep in the money as much as possible. In my case, my comfort is to go very deep in the money. Now, some people have asked, Davis, can I go for not so deep in the money? Can I go for something like 80 delta? Can I go for something like 70 delta? Yes, you can, and there's always a trade-off, right? The trade-off is that firstly, it'll be cheaper to purchase the option, but you have a higher extrinsic value, which means to say your option is going to worth much less, especially if QQQ does not move at the end of expiration. And as you can see over here, same thing as well. You're going to lose $43 out of what you purchased of this $75. So the whole idea down here of going into this 90 deltas is to reduce the amount of the extrinsic value decay at expiration. Now let's get over to the second point. So the second point, okay, my drawing is all gone down here, but the second point down here is to roll once the DTE is roughly around 60 to 90 DTEs. So why do I say to roll at 60 to 90 DTE? So first of all, rolling is just basically to continue the position. So remember, we are just trying to simulate a buy and hold of QQQ, but we're using LEAPS, right? We're using LEAPS options. And because options has a very finite date where it expires, we cannot just leave it all the way to expiration. We want to roll it to continue. So I choose 60 to 90 DTE because that's the time roughly where the theta decay starts to gradually increase even more. As you know, like I mentioned just now, theta decay is exponential. So towards the last 45 days, what you will find out is that the theta decay really decays very quickly. But if you go somewhere around 60 to 90 DTE, the decay is still acceptable. So we want to get out of this position and renew this position back to the original position again. That means you bring it back all the way to more than 1 year in terms of the expiration date. So now that I've shared with you this strategy, you might be curious, how would this strategy have done over the past few years? So how do we know whether this strategy has been doing well over the past few years? Well, the simple way is simply to just back test it, right? So first of all, you need to realize that this strategy makes sense because it is just riding on the coattails of the performance of QQQ, and it just enhances it. So at the end of the day, if QQQ keeps going up and QQQ itself is profitable, then it only makes sense that this strategy is profitable, provided you go according to the mechanics which I shared with you. That means dip in the money. If you were to go one that is at the money or even out the money, then maybe there could be some challenge because of the decay of the extrinsic value. So let's first start off by testing out how this strategy actually did over the past few years. So as you can see over here, this is the backtesting tool by Tasty Trade, and it's free to use. If you have an account with Tasty Trade, all you gotta do is go to the tab on the left hand side. So this is the web platform. Just have to click this icon over here that says backtesting, and it will bring you to this page over here. So for this, we're just going to choose a long call and make sure you can see this is QQQ. And interval, I'm just going to test it for the past 12 months first, and then we will also see after that, the past few years before this. So over here, we are just only going to trade one contract continuously. So what is the results that you can get trading this strategy continuously just using one contract? So over here, as you know, the strike, we're going to go for about 90 deltas, and the expiration, we want to go at least 1 year out. So 1 year out, I'm just going to put 365 DTE because that just means the expiration date is 365 days away, which is about a year. Now, the whole idea down here is that we basically do not want to get in and out too many times, because if you get in and out so many times, firstly, you will incur the spread. And as you know, the spread for deep in the money options is not that good because the spread of the bid and ask is going to be pretty wide. So as much as possible, we want to reduce the transaction of this bid and ask. So we're only going to pretty much roll about once a year. So this is going to be a semi-passive strategy, right? At least slightly more active than a buy and hold, but definitely much more passive than the other selling option strategies that I have on my channel. So for this, I'll just put every day as default, but I'm going to limit the number of active trades. So as you can see, I'm going to limit it to 1 and exit a specific DTE. So I'm just going to put at 90 DTE. And the rest, I'm just going to not check this box down here, just leave it as it is. And then let's run the back test. And let's just see how it's going to perform for this 1 year. So as you can see over here, the results are out. And based on the P&L, you can see that it's $7,064 based on one contract. Now, if you did a buy and hold, you can see that Tasty Trade backtesting tool, they actually compare it if you had purchased the shares of the underlying. So in this case, QQ, buy and hold is $3,284. So the total P&L is actually more than double what you will get in buy and hold. And if we take a look at the return on the used capital, you can see that the return is 66.38%. And this again is more than double than what you would get if you buy and hold. So as you can see, this is what I mean. It enhances the performance of the underlying. So although it enhances the positive aspect of the return, it also enhances the drawdown. So this is one thing to really pay attention to as well. As you can see over here, the drawdown for this strategy is 33.3%. If you had buy and hold the QQQ, you will see that the drawdown is only 13.56%. And that means that the drawdown for buy and hold is less than half of what you will get with LEAPS. So like I mentioned, it magnifies, it enhances the performance. So this is something you really need to pay attention to. Although the return is higher, you also have a bigger drawdown. So in a sense, higher risk, higher reward, but not in terms of absolute dollar for the capital that you put in, but rather because the capital you put in is much smaller compared to if you actually buy and hold, because your LEAPS option is going to be cheaper. That is why your return is going to be magnified, right? Either to the upside or to the downside. So this is for 1 year return. Now let's take a look at the past 5 years return and see how it performs. So as you can see, the past 5 years, so this would actually go back to the pandemic time at 2020 and also to the 2022 bear market. So let's just see how this actually performs. So let's run a back test over here and just let this back test load. Okay, as you can see over here, the total profit and loss, again, it's much higher than if you do buy and hold, and the return is higher as well. Now, this time it's not as great as compared to 1 year return, which you just saw just now, but it's still higher, right? Because if you buy and hold, it's about 140%, but if you use LEAPS, it's 197%. Now, over here, another thing again to take note, you can see that the drawdown also is higher. Buy and hold, your drawdown is about 35.62%, but for LEAPS is about 48.75%. So now let's go a little bit deeper and see the details of the transaction. So this is one of the beauty that this backtesting tool has, is that you can actually take a look at some of these details on this whole strategy for the past 5 years. So one thing you will note is that there are very few trades, and it's designed to be this way. As you can see, there are only 6 trades over the past 5 years, because we put the DT as 365 and we exit somewhere around 90 DT, where we roll it to the back to step 1 again, like I mentioned. So there's not many trades that we put on, and this is what we want as well, because again, this is meant to be a replacement for a buy and hold, but a leverage way of doing it. So you will see that there are 6 trades in total. 4 of them are in profit, and this one is in a loss, two in a loss. This one is in a slight loss. So what you notice is that this profits down here and the losses kind of already mimics the actual return of QQQ, because this loss down here is sustained actually during the bear market in 2022. Now 2020 is overall a positive because QQQ actually was positive in 2020. So if I was to go back to this table over here, you can see, right, in 2020 QQQ actually had a return of 48.62%, so it was positive. But 2022 it was a loss. So over the 5 years, basically you have 4 winning years and 1 losing year. And this is exactly the same with this strategy as well. Pretty much you have 4 winning years and 1 losing year. Now, there's one other thing that I need to point you out to when you're trading this LEAPS strategy, and that is that the capital when you first put up into this strategy, you may need to top up when you actually roll it again if it's a loss. So let me just show you what I mean. So if you were to go to the logs tab over here, you will be able to see all the trades that was placed and what it was closed out for. So as you can see over here, the premium at this date, when you bought the 90 delta, it cost you about $5,850 to put this trade on. So on this trade itself, it was a profit of $5,731. So that means to say now your capital is this sum of these two amounts. So 5,800 plus 5,700, you have roughly over $11,000. Now out of the $11,000, for the next trade, you need to put up $8,800. As you can see over here. So 8,800, and then you make another 7,400. That makes the sum. And then the next one, you put this amount. Now, this is all good if you start off with winning years. That means most likely you do not even have to fork out additional capital to sustain this position when you roll. But what if the very first year which you put on is going to be a loss? For example, let's say the 4th trade happens to be the very first trade that you put on. All right, so let's just remove these first 3 trades, assuming it never happened. And your very first trade is that you paid $11,100 for this trade, for this call LEAPS. Now, at the end of this trade, when you're about to roll, what you realize is that you are down about $9,000 over dollars, which means to say of this $11,000 which you put up, you only left roughly $2,000. But what you notice for the next trade when you roll, because now we need to roll back to the 90 deltas again, you need to have more capital this time. As you can see over here, it costs you $9,200 for you to put up this new position when you roll. But you already only have 2,000 left from this original 11,000 you put up because you lost about $9,000. So what that means is that your capital have left 2K. You need to top up roughly about $7,000 to put up this position. So do you see this is one of the cons of putting up this LEAPS strategy? So it's not like you put up one time and you think that based on this capital, you can always keep making more from there. It's not necessarily true, right? For buy and hold, probably so, because if you just pay the full amount for the share itself, if there's a drawdown, all you got to do is just hold on to it and you just wait for it to eventually go back up again. So there's no need for you to pump new capital into the trade. But because you're using LEAPS, LEAPS is a leverage tool. So this is where you might actually have to top up your capital if the first year is a loss. And let's say, for example, if you are a little bit unfortunate and you reach the point whereby there are multiple losses in a row. As you can see over here, this is 3 years of losses, which means to say you're going to have 3 losing trades. You need to top up each time whenever you roll to the step 1 again. So this is something very important to take note when you're trading the LEAPS strategy. Now, one last thing I want to touch on is what if you do not actually have enough capital to put on one of these 90 deltas call LEAP down here. As you can see, for this 90 delta call LEAP based off of 373 DTEs, it is going to cost you about $16,000 for you to put it on. And as you know, if this year, let's say for example, is going to be a loss, it means to say the next time you roll this, you need to add capital again. So what can you do if you don't have that big of a capital? Then this is where you might want to consider the cheaper version of QQQ. So the cheaper version of QQQ would be the index ETF called XLK. So XLK is also an index ETF, but the price is much smaller. So if I was to go to XLK over here, let me just remove all these drawings. And if we were to go all the way to the 373 days as well, you can see over here, one contract of the call lips at around 90 delta for XLK is around $8,250, which is around half of what you would have to fork out for QQQ. So if you have a smaller capital size, you can consider using XLK for this LEAPS strategy. So if you're new to trading options and you're unfamiliar with this term of rolling, then it's actually pretty simple. Right? The whole idea of rolling is pretty much just closing out the existing trade that is nearing expiration, and you subsequently open a new trade that is further out in time. That means you go for a further DTE. So when you do these two things simultaneously in a single order ticket, this whole act down here is called rolling. So as you can see, it's pretty simple, nothing complex about this, and you can very easily do this in your broker platform. Most broker platforms should give you a way to roll your trades, where you close out your existing trade and open up a new trade, all in a single order ticket. So the very next important question that you need to ask yourself is, what exactly is the purpose of rolling? Because a lot of times people tend to roll for the wrong reasons. Not all the time you actually want to roll. So what exactly is the purpose of rolling? So in general, there are two purposes. The very first one is to continue the trade, potentially increasing profits. So this scenario basically just means that your position, current LEAPS position, is in a profit, and you still have a bullish view, thinking that the market is still going to go up, and this is where you want to continue the trade because it's already getting close to expiration. If you do not do anything, then the trade will pretty much expire and the trade cannot continue. So at this point of time, you will have to roll in order to continue the trade, and if the market continues to go up, or the underlying or the stock that you trade continues to go up, you're going to be in more profits again. And by the way, when I say you make profits when the market is going up, it's because I'm very specifically talking about the call lips down here and not the put lips. So if you're going to buy put lips, then it's going to be opposite. The market has to go down in order for your position to be in profit. Now next, the second purpose is to prolong the trade for potential recovery. So in this scenario, your current trade is actually in a loss or in a drawdown. So this is where you probably still have a long-term view where the market or the underlying, the stock that you're trading is still going to go up, and it's currently still down at the moment, so you're taking a loss. So in order for you to reach the point where your trade is going to be in a profit, this is where you can roll it to prolong the trade for the eventual recovery, and this is where in the end it can become a net profit. So these are the two purposes of rolling, and as you can see, the general idea here is to just extend the life of the trade. So whether be it to increase the profits if it's already in profit, or to eventually recover where you turn your current trade, which is currently in a drawdown, to eventually into a profit. So these are the two purposes of rolling, but the more important question you should be asking yourself is, should you actually roll? Because believe it or not, a lot of people, when they get into rolling, the idea of them rolling actually is not necessarily right. So they are rolling for the wrong reasons most of the time. So the question is, should you actually roll or not? And the answer is yes, if and only if, very important, only if you still have a bullish view. That means you still think that the underlying, the stock, is going to keep going up. Because if you don't think it's going to keep going up, then there's no point to roll it at all. At that point of time, if you think that the market is not going to go up, then you should actually not roll this. Which leads me to the second part. So you shouldn't roll. The answer is no, you shouldn't roll if you're simply hoping that the underlying will go up. And this is very important because a lot of people think that rolling is going to somehow magically turn you into a profit. And that's not true, because rolling can actually be a double-edged sword. Because if the market goes up, yes, you're going to be in profit. But if the market goes down, then you're going to be in a bigger loss than if you hadn't rolled in the first place. So that is why it's very important to first identify the reason for rolling. And the only time you should be rolling is if you still have a bullish view. So what to do if you're unsure, if you do not even have any view whatsoever? Or worse, you think that the market is not likely to go up. then in this case, we need to use the wise words of somebody by the name of Russell Peters. Be a man, do the right thing. So if you have no idea what I'm talking about, you know who is Russell Peters, then just do a Google search, find this man, and you understand what I mean. So what exactly is doing the right thing in this context? Well, doing the right thing over here simply just means to close the trade and take the loss like a man or a woman, right? Of course, if you're a woman doing the trade. So if you're unsure if the market is going to go up or the stock underlying is going to go up, and the only purpose that you are planning to roll is because you do not actually want to take the loss, but you actually are, because when you're closing the trade and opening a new one, you actually have to close out for a loss first before opening a new trade. So that is why it's very important to identify whether you are still bullish on the underlying. If you are, then yes, the rolling makes sense because it's going to play out to your view if the market or the stock, the underlying, eventually goes up. But if you're unsure, or even worse, you don't even think that it's going to go up, then you shouldn't be rolling in the first place. So here are some very, very important points that you really need to take note of if you're thinking of rolling or even putting on the LEAPS strategy in the first place. So first of all, you need to understand and realize that rolling is not a repair for a losing trade. Many times you might hear people say, hey, this is a repair trade by rolling. That is only kind of true if the underlying that you've chosen goes up. Then in this case, it's kind of like a repair, although it's not, right? People like to use this term repair just to make it sound attractive. But in actual essence of this rolling trade, it's not really a repair at all. Because while rolling can potentially increase your profits or potentially turn your trade into a profit if the market continues to go up, it can also, very important, I'm going to put a star down here, it can also easily turn a profitable trade into a loss, or worse, increase your losses. Because let's say, for example, your trade is already in a profit. And at the point of time, if you're unsure if the market is going to continue going up and you're just putting it on hoping and praying that it continues to go up because maybe for greed, you want more profits, then guess what? If the market is suddenly going to do a U-turn and then just go all the way down, then all of a sudden the profitable trade which you had previously could eventually turn into a net loss from this roll which you did. Or worse, increase your losses. That means if you initially already had a losing position and then you roll it, it could further deepen your losses if the market continues to go down again. So remember, rolling is not a repair for a losing trade, and you only want to put it on if you have a bullish view still. Now that I have gotten that out of the way, the next thing is, when should you consider rolling? And the answer is when it's getting close to expiration, where the theta decay, a very important concept, starts to increase exponentially. So most of the videos that I've created on this channel basically is around selling options. So when we are selling options, theta decay is actually on our side. Because when we are selling the premium, we hopefully want to buy it at a lower price than when we first sold it, or have it all expire worthless. This is how we make profits when we are selling options. But when we are buying options, then theta decay is going to be our enemy. It's going to be our nemesis. It's going to be our kryptonite, whereby when the theta decay starts to get higher, what actually happens is that our value can start to deteriorate over time, because as it gets closer to expiration, all the extrinsic value that we have in the option actually goes down to zero. And when it goes down to zero, this is where our option value can actually be lower than what it actually can be. So exactly when should we consider rolling? So this is where we want to take a look at the theta decay curve, because there's going to be a part on the curve where it starts to increase exponentially. So let's take a look at the curve over here. And over here, you can see this is the theta decay curve, and you can easily just go to Investopedia or just do a Google search, and you should see many of this kind of graph down here. So you can see over here, this is actually an exponential decay, the increase. It's rapidly increasing in the decay as it gets closer and closer to expiration. So you can see over here, 9 months, the plane over here is not that steep, right? From here to here, maybe it's something like this. But as it gets closer and closer to expiration, you notice the steepness actually increases by quite a bit. So that is why we want to roll it before this increase in the theta decay really kicks in, where it becomes really exponential. So where exactly in time is this? This is usually around the last, I would say, 60 to 90 days. So around 60 to 90 days, I would say maybe somewhere around here. And as you can see, if we get to even closer to the expiration, maybe the last 30 to 45 days, it gets even more steeper in terms of the theta decay. That's where you're going to rapidly lose value in the extrinsic value of your options. So ideally, this is kind of the place where I want to start to roll, because at least this is where when I roll, I kind of renew the curve, the reset of the time decay, where the decay is no longer going to be that quick anymore. Then it goes back to kind of slowing down again, and then eventually when it comes back down to this point again, then I'm going to roll again. So where is this point exactly? So I would say this is somewhere around the 60 to 90 days mark. So around 60 to 90 DTE, this is where you might want to consider doing the roll. Now, if you don't want to roll so early, you can also choose to wait until it's closer, maybe around the 45 to around 60 DTE mark. So anywhere around here is fine. You just need to know is that as it gets closer and closer to zero, this DTE, this is where your theta decay starts to pick up, and your option value in your LEAPS starts to rapidly decay from the extrinsic value point of view. Okay, now that we know when we should start consider rolling, let's get into the actual rolling strategies, because there are two different ways that you can actually roll it. So the very first way is to roll to the initial delta, and the second way is to roll to reuse the remaining capital. So two different ways to roll it, and this really depends on your objective. So the very first one that I'll get into is rolling to the initial delta. So what it just means is that you're going to roll to the initial delta that you first started off with. So let's say when you first put on the LEAPS strategy, let's say you started off with 90 delta. And let's say by this time, maybe it could have gone up to, let's say, around 97 delta, or it may have gone down to, let's say, around, say, 70 delta. Around there. Okay, so basically either a higher delta or a lower delta. So by rolling to the initial delta, what it simply just means is that from this trade, you just roll to the new trade back to 90 delta. So there's going to be two slightly different end results, so to speak, depending on whether the current trade which you have, which you're rolling, is in a profit or in a loss at the moment. So if the current position is in a profit, then by rolling to the initial delta, in 90 delta in this example, then it will result in a net credit. So let me show you exactly what I mean over here. So if I was to go to some of my positions over here, you can see that I do have some trades over here, the LEAPS, which I had actually rolled. So you can see over here, this trades down here still have quite a bit of time to it. It's 541 days left. That means to say it's more than a year. So we're not even close to the point where we are going to consider rolling. So I can't exactly use this as an example, but I'm just going to give you an idea as to how it can be done. So as you can see over here, I do have some positions that I've already rolled, because previously it was already deep in profits. It was already in profits, and at the point of time, it's getting close to expiration. So I wanted to roll to continue the trade to potentially increase the profit. So if you remember, let me just go back to the slides down here. The purpose of rolling, there are two. So because my initial trade was in a profit, when I roll it again, the idea here is to continue the trade, potentially increasing the profits, because the underlying is actually an index ETF, which is QQQ, and I do have a bullish view. I choose to roll it. So let me show you another underlying which I have the trade on, the LEAPS on, which is on Meta. And this is a roll trade. Again, previously it was deep in profits already, so I decided to roll to continue the trade. So how exactly should you be rolling to the initial delta? So for this, I'm just going to use the example down here. Now let's just imagine this is going to be like around 60 to 90 DTE. So this is definitely still far out, right? We're not going to roll this anytime soon. But for the purpose of this example, just to show you what I mean by rolling, if it's currently in a profit, you will get a net credit. So let's just imagine that maybe this is like 60 DTE left, okay? So let me just go and find my position first. So this position right now, because it's in the profit, you will find that it's going to be pretty deep in the money right now. So there you go. This is where my position is. When I first put it on, it's somewhere around close to 90 deltas. And as you can see over here, the delta has already increased because the market has gone up, or rather Meta has gone up ever since I wrote the trade. So now it's in a profit. So when the underlying actually goes up, when you put on the position, it now becomes deeper in the money because right now it's further from where the current market price is. So this is where the current market price is, somewhere around here. You can see the line down here denoting where the options is in the money, which is the gray part down here, and out of the money, which is the non-gray part down here. So if it goes deep in the profit, this is where you're going to see the delta starts to increase, and the opposite is true as well. So for example, if you are in a loss right now when you first put it on, then chances are that your position is going to be somewhere lower than 90 delta, maybe somewhere around here. So as you can see over here, let's first take a look at what is the cost for putting on this trade in the first place. How much did I pay? So you can see over here, the trade price is 455 and currently it's marking for 589. So if I roll this to the initial delta, which is around 90, I'm going to receive a net credit. So let me just show you exactly this whole rolling down here. So to roll it, you're simply, remember, it's a two-step process. You're just closing out the existing position. So since I already have a long position down here, closing it out, I just click the bid. And then now I'm going to go to a further DTE. So in this case, let's just use the furthest one that is available. And that is 905 days. So I'm going to go to the 90 delta to put on the trade as the second part of rolling. So the second part of rolling is simply just to reestablish the trade, but at the 90 delta. So once I put this on, you can see this is actually lesser for me to put on than what I sold the initial trade for. Because right now, the value of the trade, as I've shown you just now, let's just take a look again, is currently marking at 589. So if I was to close out at 589, and then I put on the new trade at around 438, there's going to be a spillover of a profit. It's going to be a net credit. As you can see over here, it becomes minus 156. So that is going to be a net credit of around $15,000. So let me just show it to you. If I click review over here, you can see over here, it says a credit of around $16,000, right? $15,690 to be exact. So this is what I mean, that you're going to have a net credit when you roll it if you are in a profit, which is, let me just scroll it down here. There we go. So you can see over here, if the current position is in a profit, which the example I showed you just now is in, it will result in a net credit. But if the current position is in a loss, it will result in a net debit. And a net debit just means that you do have to top up from the initial amount which you had put on the trade. So let's say for the trade which I had put on down here, let's say it was a 455, right? If I'm not mistaken. Let's just go and double check again. So I'll just remove this position. Let me remove all these drawings as well. So let's take a look again. So the initial cost was 455.88. Okay, so let us simulate that right now it's in a current loss. So let's say that the market has dropped since then. And if the market drops, you will see that the strike price that you have chosen is now closer to where the current market price is, right? Closer to an at the money option. So 510, let's use this as the example, around 80 deltas. So the price have actually dropped as well, the value of this option, because I purchased the initial option for around $455. What is it worth now? It's worth around $295 to $298, around $300. So we have actually lost money on this trade. So how do I roll this? So to roll it, you have to go to the initial position. Okay, so first off, as you can see over here, I looked at the wrong DTE. So it's very important to make sure that you have it on the right DTE, okay? So I'm just going to close out this first. Let me just go over the 541. And let's just take a look at the let's just use 500 strike price as where the strike price was when you first put it on. Okay, so we bought it for around $455. So now it's currently marking at around 269. So we do have a current loss on this position. So to roll it again, simply just close it out. So it is a long position initially. So just imagine this already is a long position at 500 strike price. I'm just going to sell it to close out the position. And then same thing, I'm going to go out to the further DTE. And now I'm going to go to the 90 delta. So if I go to the 90 delta, you can see over here, the ask is around 438. Right? If you go for the mid price, it's going to be somewhere around 433 thereabouts. So if I click this, straight away you can see that it's going to be a debit. Why is that so? Because we closed that initial position, which is going to be around $200+, and then we are going to buy a much more expensive option down here because we want to go back to the 90 delta. So over here, you can see now we are in a debit of around 162, which is going to be about $16,000 plus. So if I click the review over here, you can see that it says down here it's net debit. That means now you have to top up if you wish to roll it to this same initial delta which you had initially first put on the first trade. So this is why I say that if the current position is in a loss, it will result in a net debit. Now, the second way to roll is to reuse the capital, the remaining capital. That means to say the whole idea down here is that you actually do not want to top up. If you do not want to top up, then this is where you roll to reuse the capital. So the whole idea here is to just use the value of the current existing option to roll to the new position. And this is where the delta actually can change. So depending on whether the position is currently in a profit or loss, the delta will be greatly different from each other. So you can see over here, if the current position is in a profit, then there are two things you can do. You can either roll to a higher delta with one contract or roll to a lower delta with two contracts. So what you're doing down here is really just kind of like compounding the amount which you have gotten from the existing position, and then you compound it to two contracts. So what this does is that if the market actually continues to go up, you're going to make even more. But of course, if the market comes down, then it could actually turn your initial profit to a net loss in the end, because now you have two contracts. So let me just show you how it's done. So let's go back to our initial position down here. So let's say our initial position now is in a profit, and you can see that I have about $587 or $589 around the mid price down here. This pretty much is the value of my current option. And to reuse this capital basically just means that I'm going to find the option in the further DTE that fills this amount exactly. So let's just go over to the further DTE to take a look at what are our options. So the very first option, right, very simple, very straightforward. All I got to do is find the option strike price that is roughly around this price down here, 589.9. So if I was to take a look at the option chain down here based on the ask price, we are pretty much just, I think, this option down here. So the mid price is going to be around 585. If I go for this one, this is going to be slightly lesser and this is going to be slightly more. So if I choose this down here, I'm most likely going to get some credit, although I try as much as possible to reuse the whole amount. So you can see over here, I get a net credit of around 492, which is about $492. And what you notice down here is that my delta has now gone up to 97 deltas. So our initial delta was around 90 deltas, but because I want to reuse the capital, I have to go to a much deeper in the money option. So you might be wondering, Davis, why do you want to exactly do that? And the reason why I might consider doing this is mainly because of the extrinsic value. So like I mentioned before, extrinsic value is going to be our nemesis when we are buying options. So as much as possible, we do not want to buy the option where there's too high of an extrinsic value, because the higher the extrinsic value, the higher the theta decay is going to be as well. So if I was to go to the extreme end, where it's pretty much at the money, you can see down here, the extrinsic value is about $183. Pretty much is $18,300 worth of extrinsic value. Which means to say, if the market doesn't even move at the end of this expiration of this option, I am going to lose everything down here. But if I choose the one that is very deep in the money, using this example over here, you can see the extrinsic value is only $12.80. So this is so much smaller compared to what we've seen just now. So what this means is that if Meta just doesn't move at the expiration of this option, all I'm going to lose is just $12.80, which equates to about $1,200. Compared to the amount down here, which is about $18,000, this is going to be much, much smaller. So that is why this is one of the considerations I have when I want to roll as well. Now, the next consideration is that you want to kind of compound your profits. And this is where you take the amount which you have received from selling the initial option, so which is the one down here, then you split it into two options instead. So how do you split it into two options? Well, you just have to find the amount, which is roughly around 590 divided by 2. So 590 divided by 2 is going to be around 295, I believe. So instead of just buying one option at 590, I am going to go and find the strike price that actually is worth around $295, and I have two contracts for that. So as you can see over here, I kind of have two different candidates. So either I can go for two contracts of 510 or 520. With 510, chances are that I might have to top up a little bit, because if I was to click this and I was to go two contracts, then it's going to be slightly more expensive. So let me just increase this to two contracts. And you can see over here, I have to top up roughly about $3.73, which is about $373. Or if I go to the 520, so let me just adjust it over here. If I go to 520, then I'm going to get a net credit. So my net credit is about 927. So in exchange for having these two contracts to kind of compound my profits, I'm going for a lower delta. So with a lower delta, what you notice is that your extrinsic value is going to be much higher. So this is $98 in terms of extrinsic value. And because you have two contracts, your extrinsic value is kind of much more right now. So that means that if Meta actually does not move at expiration, that means the price is still the same when this option expires, then you're pretty much going to lose 98.83 times 2 because you have two contracts. Whereas compared to if I had it over here, at around, I can't remember what it was. I think it was somewhere around here. I think this strike down here, 130, where the cost is close to around 600. You can see my extrinsic value, all I'm going to lose is only $12.50. So this is something that you really need to think about. Are you much more concerned that the underlying is not going to move or maybe even go down? Then in that case, maybe you might want to consider going for this method instead, where you're going for much deeper in the money, but only one contract. But if you're much more in terms of, I want to get much more profits, I want to compound my money, and you're not too concerned about the downside, which can actually happen, then you can choose to go for this. Now, if the current position is in a loss, then you pretty much have to roll to a lower delta than your initial delta. So it's pretty much like this down here. You're rolling to a lower delta, but this time you only can have one contract. So let us take a look over here again. And using the example, I think it was 500 strike price. So let's just use 500 strike price. Let's just say that right now, your option value has dropped to around $270 thereabouts. So in order for you to roll it and you do not want to top up, you have to find the option strike price that is around this price. Because what you're doing is simply just closing out this trade. So you're selling it off, and then you're putting on a new trade at a further DTE that is around the same value as the option which you're planning to close. So in this case, I need to find the option strike price that is only going to cost me roughly around $270, as you can see over here. So the only choice which I pretty much have would be this one down here. If I go to 273, this one, this is where I'm going to top up a little bit. So if you don't mind topping up a little bit, you can go for this. But if you do not want to at all, then this would be the choice down here, which is 560. So in this case, you actually can still have some credit to your account because the option which you're purchasing is actually lesser than the trade which you closed out. So you will notice that the delta for this is going to be so much lower than the initial delta that you put on. So we use the example of 90 delta. So in this case, you can see that from 90 delta, it has dropped to 77 delta. It's quite a big jump. And you can see over here, your extrinsic value is going to be so much higher as well. So if you do not want to top up for the trade, you want to keep this capital consistent, especially if you've only set aside a certain amount just for the trade, then this is the only choice that you pretty much have. So if you choose this route down here, you got to be very certain that your view is still going to be bullish, or at least the underlying have a chance to go back up. Because if it doesn't, then at the end, where it's close to expiration again, around the 60 to 90 days window, this is where you need to make another decision. Because if it's going to still be in a loss, then guess what? This is going to be at a lower value again. Maybe this time the amount could be around $100 something, and then you have to do the roll again. So you need to find a further DTE where the option is going to be around this new value of the option again. So that means chances is going to be even lower delta, to the point that it could even get very close to around at the money. And that's when it's going to be pretty dangerous for the LEAPS strategy because now you're going to have a pretty high amount of extrinsic value. And again, extrinsic value will always decay as you get closer and closer to expiration. So that is why the initial LEAPS strategy, when you put it on, we want to try and get not too high of an extrinsic value as possible. So how do you trade LEAPS if you don't have that big of account? So first of all, as you can see over here, these are some of my LEAPS positions that I have on the QQQ. So if you were to take a look at the cost over here, you can see that it's not that cheap. It's pretty capital intensive. So each of these options down here, which I have bought, it is about $20 plus to $30,000. You can see this is 32,000. This is 26,000. And these two over here are two contracts, so they're about $30,000 each. So how can you trade LEAPS if you don't have that big of a capital? Let's say, for example, you have 10,000 and lesser. So I'm going to give you a few suggestions on how you can trade LEAPS on your account if you have a small account. How do you adapt this strategy to a small account? So the very first way I would say is to go for a lower price underlying. So this can be lower price stocks, or you can go for the lower price index ETFs. Now, generally for the lower price stocks, if you want to use the LEAPS on it, I would prefer if you do it on fundamentally good stocks. That means to say the company of the stock has at least been profitable over the past few years and the fundamentals are strong. So there are quite a number of things that goes into fundamentals, which I won't go into here. You can easily research on Google. But one of the issues or challenge that I found is that the lower price stocks, they do not tend to be the fundamentally good stocks. Usually fundamentally good stocks are a little bit more expensive. So that is a little bit hard to find. But although there can be a few that can be found, you just have to do a little bit of digging. Now, the alternative to that would be to go for the lower price index ETFs. So for example, QQQ is the tech index ETF. So if I was to go to one of these options down here to buy the LEAPS. So generally for myself, I like to go very far dated ones, very far DTE. So as you can see, this one is about 519, but when I first put it on, it was much higher. So let's just say we go for the furthest one, 883. And usually I like to go for around 70 to 90 deltas. So if you go for 90 deltas, there will be more intrinsic value, less extrinsic value, which is what we really want when we are trading LEAPS, because when you're buying options, extrinsic value is always against us. So when you go for the higher delta, as you can see over here, the extrinsic value gets lesser. And if you're not already aware, over time, as we get closer to expiration, this extrinsic value will slowly start to go down to eventually become zero at expiration. So that is why when you go for the higher delta, you're going to have lesser extrinsic value, which has less impact to reduce your overall value of your options. If you will go to the 70 delta one, let's just say we go to the extreme over here, 70 delta, which is actually fine, by the way, as long as you don't go until too far out of money, like let's say, for example, 50 delta, that is going to be pretty much all extrinsic value, as you can see over here. So with the 70 delta one, it's going to be much cheaper, but you're going to have more extrinsic value. That means to say, if the market do not go up as quickly over time, then all this extrinsic value will slowly start to go down to zero. So over here, you can see that if you go for the lower delta, it's going to be much cheaper than if you go for the one at 90 delta. As you can see over here, this is $303 on the ask, which just means it's about $30,000 per option contract. Now, on the other end, for the 70 delta one, you can see it's about $130. That's about $13,000. So that's still quite expensive, right? Especially if your account size is less than $10,000. So the alternative for this QQQ Tech Index ETF would be XLK. So XLK is also the index ETF for the technology sector, as you can see over here. And it's actually lower priced than QQQ. This is $260, whereas QQQ is at $562. So naturally, the options are going to be more expensive over here. So let us take a look at XLK. Now, one thing about XLK is that the options are not as tight of a bid-ask spread compared to QQQ. So if I was to go to the same 883 days, you can see that the spread is generally wider. It's about $10 wide. So if you don't mind this, this is one alternative that you can do. And let's just say we go for the 90 delta option. It's about $126. So this will cost you about $12,000. And if you go to about 70 deltas, let's say somewhere around here, or maybe even 80 deltas, somewhere around here, it's going to be much lesser. So it's going to be somewhere in the vicinity of around $6,000 to $8,000 per contract. So this is going to be less expensive, less capital intensive compared to QQQ. So this is one alternative that you can consider if you want to consider a tech index ETF. Now, if you find XLK still a little bit too expensive, maybe because your account size is much smaller, then the other alternative would be to use the other index ETF, which is the financial index ETF, and that is XLF. So XLF, if you're not familiar, basically this tracks all the financial stocks. And let me just very quickly show you the chart as well. So as you can see, this is the XLF. And this is also what I consider a positive drift underlying as well, because over the long term, it wants to go up. Now, of course, it has a very big crash in 2008, mainly because it is the financial crisis. So being a financial index ETF, this really took a very big hit. It went from about $30 or so. It dropped down to the single digit dollar, right? Maybe around $5. So it was a really big crash. But after that, the market starts to pick up and eventually it breaks through the highs and it continued going up. So this is one of the underlyings that you can consider because the price is not that high. So if we were to take a look at the call LEAPS options for this, and we were to go to 883 days as well, the furthest dated one, and we go to, let's say, the highest delta, which is around 90 delta, it only costs you about $27, which is about $2,700. And the extrinsic value, relatively is not that high as well. It's only about $1.93. So that means to say you pretty much retain a lot of the value, even though XLF do not move. Let's say after the expiration date, 883 days later, the price pretty much is at the same price as when you first bought the LEAPS. So all you're going to lose is just this extrinsic value, because the remainder is the intrinsic value, and intrinsic value does not decay over time. So if you were to go for the 70 delta, it's going to be much less expensive as well. It's going to be about $11. So it's going to cost you only about $1,100. So XLF is going to be one consideration if you don't mind the risk attached to it. So the question is, how did this strategy do over the past 5 years on XLF? So for this, let's head on over to the Tasty Trade platform where you can access the backtesting tool. So the backtesting tool is going to be, a pretty good tool for you to at least analyze any strategy that you want over the past few years before you actually put on the trade. So if you see the backtest has a chance of it being profitable, then at least you're going to have a better chance of it being profitable when you start placing the trade live. So any strategy you want to put on, I would say if you do not have any statistics to back up that certain strategy that you're trading, at least lean on the backtesting tool to kind of get an idea as to how it can perform over the past number of years. So at least it gives you a better indication of how it might perform in the next few years. So over here, I've already populated some of the fields over here. You can see I put XLF, and we're just going to test over the past 5 years. And the delta that we're going to choose usually, like I mentioned, is 70 to 90 delta. So for this example, I'm going to put 80 delta. And the expiration date is anything from 365 days and above. So for this, I'm just going to put 365 days. And I'm going to exit at around 90 DTs. So basically, we want to exit the options before the theta decay really kicks in. So the theta decay really kicks in somewhere from 45 days and below. Right, so if you want to play it a little bit safer, whereby the theta decay does not really kick in, then you can go for somewhere around 60 to 90 DTs. So anywhere from that range is absolutely fine. So in this case, I'm just going to use 90 DTEs, and then I'm just going to hit the run back test, and let us take a look at how it performed over the past 5 years. Okay, so the results are out, and overall it is going to be net profitable, although sometime in 2022 it's going to have a drawdown period, which is natural because this is a bullish strategy and 2022 was a bear market. So naturally the strategy is going to be in a drawdown. So the return for your used capital is going to be about 208%, drawdown is about 40%. So if we were to compare this to if you were to just buy and hold the stock, it's going to be a better performance. So if you were to just buy and hold the stock, it's about 135%. So 280% is much higher than that. But at the same time, your drawdown is going to be higher as well. So if you were to just buy XLF and hold it, the drawdown is going to be only about 25%. So If you were to use the LEAPS, the drawdown is naturally going to be higher. Why? Because this is a leverage position. When you buy options, this is going to be a leverage position. So what it essentially is doing is just magnifying the underlying performance. That means to say, if it's going to be a net profit overall, the net profit is going to be higher, but the drawdown is going to be magnified as well. And at the same time, if let's say, for example, it's going to be a loss. So let's say if we were to take a look at 2022 by itself, then XLF is going to be in a loss. If you're going to use LEAPS on that period, then your loss is going to be magnified as well. So you're going to probably have a bigger negative return compared to if you were to buy in a whole stock. So this is very important to understand when you're trading LEAPS. So the most important thing is that as long as you continue in the position, let's just say that you want to be in the position for the long term, then as long as the underlying goes up, your performance, your results is going to eventually going to be a net positive as well. That is why it's important to choose a positive delta underlying either index ETF or a fundamentally good stock. Now, the next thing, let us dive a little bit deeper into some of the details down here, and let us take a look at the year-by-year performance. Overall, the win rate is about 83%. Only because, right, it has been pretty bullish over the past 5 years and with one big loss. Now, the most important thing is to see what is the average buying power per trade. That means to say, what is the cost of putting on the trade on average? So it's $763. That means to say, if you have an account size that is 5,000 or smaller, you can definitely put on the LEAP strategy on your account with XLF. So let us go to the details, or rather the trade by trade analysis at the logs over here, and let's take a look at how much it would have cost you per option. So you can see that this is the buying power. So the average about 700 plus, as mentioned in the details section. So when you first put it on, right, it's roughly around 585, then 695, 835, 923. Now here's what's the most important thing to understand. So whenever you have a profit, after you roll it, you're usually going to use lesser of the total amount. So let's say, for example, the very first trade you put on is $585. You made $945 for that. So your total that you get, including the capital you put in, is going to be $945 plus $585. So roughly it's going to be about $1,600. Now, when you roll it, generally we want to roll it back to the same delta that you have used previously. So if you have used 80 delta previously, then you're just going to roll to 80 delta. And at the point of time, you can see that for this roll, it's going to cost you $695. So out of the total of $1,600 that you have in the capital based on this transaction, you're only going to use about $700 for the next trade. So you pretty much have some leftover. So this leftover, it will generally be used if it's going to be in a loss. So for example, you can see over here, $835 for you to put on this trade. Now it's going to result in a loss of $613. So what it means is that out of this $835 that you have put into for this position down here for this option, you're only going to end up with about $200 left, because you have lost about $600. So out of the $200 that you have left, if you were to roll to the next trade, which is down here, at the same delta, you can see that it's going to cost you $923. So you only have $200 left of this position. So what do you have to do? So this is where you do have to top up. So it's very important to understand. So you do want to set aside some capital in case you hit a loss for the year. So let's just say, let me just remove all this. So let's just say the very first trade you put on is not this too, right? The very first trade you put on, a little bit unfortunate, happens to be a loss. So you put in about $835. At the end of the day, you're going to be left $200 plus dollars because you have lost $613. Now you need to top up to put for this trade. So this is very important to understand when you're trading LEAPS. That means to say, if you, let's say, have a $5,000 account, you do not want to put the whole $5,000 into the LEAPS. So some people will do that. For example, they see that, oh, it costs $835. I have $5,000. I'm just going to max out my capital to buy all the LEAP position that I can get with the 5,000. No, you do not want to do that, because you have to expect that certain trades can be a loss where you do need to top up. So this is very important to understand. All right, so this is the first way that you can trade LEAPS if you have a small account. Now, the next way that you can trade LEAPS with a small account is to modify the DTE a little bit. That means to say, instead of going for the very far out DTE, like 800 plus days, you want to go to a shorter term. So I would say somewhere around 180 days if you want to have a lower cost for your LEAPS, because you will find that if you go for the lower DTE, the cost also drops as well. So if I was to compare this, so let's just say I was to go to around 80 deltas. 80 deltas, you can see over here, it's only $83. And if we compare this to the 883 days at around 80 delta, so let me just go all the way up, you will see that the 80 deltas here is going to cost much more. So 80 deltas is the same delta, but it's going to cost you more than 2 times the cost of one on the 180 DTE. So this is one way that you can work around if you have a smaller account. So this will still be considered LEAPS, because LEAPS generally, at least the technical term, is anywhere from 180 days to higher. So at the minimum, let's just go for around 180 days. And if you want to make the price even less expensive, then what you can do is you can go to around the 70 deltas, because what you notice, like I've showed earlier, if you go for the lower delta, you're going to have generally a lower price for the option compared to if you go for the higher delta. So if I was to go to 90 delta, you can see that this is about $138 on the ask. So this is going to be more than 2 times the cost of the 70 delta. And 70 delta, I would say, is the lowest delta you want to go, because any lower than that, the extrinsic value is going to start to increase, where it's going to pretty much be all extrinsic value in your options. That means to say, if the underlying, so for this, I'm using SPY as an example, which you can definitely use, especially if you're more risk averse. You don't like to go for the tech index, where it can be much more volatile. So S&P 500 will be less volatile. And using this method, you can actually put it on a smaller account if you go for the 180 DT. So why you do not want to go for the really out of the money options down here, even though they are so much cheaper, is that what if the next 5 years, the market just goes sideways? If it goes sideways, then pretty much what's going to happen is you're going to lose all the value down here. So that means your option is pretty much all going to zero. And that's not what I like. So if you were to go for the higher delta ones, at least your extrinsic value is not that high. So you do have some buffer in case if the market just goes sideways, you do not lose as much. So if you want to go for a lower cost, you can definitely go for the 70 delta one. So it's going to cost you about $5,500 to put one of these options on. So again, let's take a look at the performance. Very important. We always want to lean on statistics, results, to take a look and see how it would have performed over the past 5 years. So again, let's head on over to the backtesting tool, and I've already populated the fields over here. So I'm going to go with 70 delta, and over here I choose 180 deltas. Now for the exit at the specific DTE, I'm going to put 45 DTE instead of the 60 to 90, because if you're going to put the 90 DTE, while it's possible, you're going to be much more active. You're going to roll it much more often. And generally for LEAPS, I do not like to roll too often. And the main reason is because generally with LEAPS, it's going to have more cost if you're going to keep rolling because of this bid and ask spread. So every time when you roll, you're losing to the bid and ask spread. So as you know, if you go for the higher delta ones, you can see the spread can just pretty much be much wider. So every time you roll, you're going to incur this spread cost. So that is why I put at 45 DTE to roll, so that we don't roll as often as compared to the 90 DTE. So 45 DTE, that's the point where the theta decay is going to start to rapidly increase. So we want to get out of the trade and start to roll it before it gets to the point. So I'm going to hit run back test, and let us take a look at the results for the past 5 years. Okay, the results are out, and as you can see, LEAPS on SPY again is going to be a net positive after a number of years, although again similarly in 2022 it's going to be in a drawdown again because it's the bear market. So it's very important to stay the course if you plan to trade this for the long term. So my strategy for LEAPS generally is going to be a long-term kind of position. So we can take a look at the returns over here. It's 249%, and the drawdown is going to be about 53%. So the drawdown is going to be pretty high as well. And again, like I mentioned, it's because we magnify the underlying results. So how did SPY perform if you just buy and hold? So if you were to take a look at the buy and hold position down here, the return is 94%. So by using LEAPS, you dramatically magnify the return. So you're going to get a much higher return, but at the same time, of course, your drawdown is going to be more than if you were to just buy and hold. Buy and hold is about negative 25%. So with LEAPS, you're going to magnify both the profits as well as the loss. Next, let us take a look at the details and have a more detailed look as to how it performed in terms of the trade by trade. So the profit rate is about 69%, again, because over the past 5 years, mostly it's bullish. And what about the average buying power? So the average buying power is about $4,000. So if you have account size about $10,000, this is going to be okay as well. So next, let's take a look at the very important log section, because now it tells us what is the amount that we might have to top up if it's going to be a loss for the year. So similarly to what I shared with you in XLF, if you do come across a loss, then this is where you do need to have some capital to top up again. So in 2022, this one down here is going to be where you're going to have probably the biggest loss. So you paid $4,600 for buying the call LEAPS, and at the end of the period where we get to roll at around 45 DTE, you're down 4,500. So essentially, the whole value of this call LEAPS is going to be gone, right? All you're going to be left is maybe less than $100. So you can see the ROI here is almost 100% loss. So this is something that you do have to note. So you do have to set aside, again, capital in case this happens and you want to roll. So the next amount is going to be $5,000. That means to say you pretty much have to top up the $5,000. And then if you're going to lose about $3,000, it becomes $4,000 next. So you have to top up probably about $2,000 or so again to resume this position. So at this point of time, you have lost total about $7,000 thereabouts. So this is very important. That is why we do not want to put our whole capital into all the positions. This is something that a lot of beginners make the mistake. You do want to set aside some capital, right, for in case the market actually crashes, and then you need some capital to start to roll. So as long as you continue doing this, as you can see, when the market eventually becomes net positive, when the market starts to recover, you're going to get the profits as well. So one alternative is that you can actually time it if you want to. That means you wait until, maybe you're following technical analysis or support and resistance, time it until you find a better entry point to put on the LEAPS. You can do that. So if you have a small account, you can definitely trade the LEAPS strategy as well, as I've shared the two methods in this video. So hopefully this video has helped you, and if it has, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this, and I will see you in the next one.